The fact that the SEC is suing OpenSea at the same time that you have pretty smart people also asking the SEC for a declaratory judgment, which gives them clarity and clearance to engage in bona fide artistic activity, suggests that the current regulatory approach being adopted by the agency is maybe less than appropriate for the space, and that maybe they're overreaching in the OpenSea case.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin, author of The Cryptopians. I started covering crypto 9 years ago, and as a senior editor at Forbes, was the first mainstream media reporter to cover cryptocurrency full-time. This is the August 30th, 2024 episode of Unchained. Today's episode is brought to you by Gemini, a US-based crypto exchange built for new and advanced traders. Gemini is offering new customers $15 in BTC when they trade. Sign up today to earn your Bitcoin. FBTC is the fastest growing omni-chain BTC asset this summer. Join FBTC Points-inspired campaign where you can hold FBTC to earn sparks, lucrative yields, and token drops, all on your Bitcoin. With iTrust Capital, you can buy and sell crypto in a tax-advantaged retirement account. Enjoy significant tax advantages, 24/7 access, and the industry's lowest fees. Polkadot is the original and leading Layer 0 blockchain with over 2,000 plus developers. And the Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem. Join the community at polkadot.network/ecosystem/community. Get ready for the world's largest crypto event, Token 2049 Singapore, from September 18th to 19th. Join over 300 speakers and 20,000 attendees. Visit token2049.com for 15% off with code UNCHAINED. Today's guest is Preston Byrne, managing partner at Byrne & Storm. Welcome, Preston.
Great to see you again.
On Wednesday, NFT platform OpenSea announced that the SEC had issued it a Wells notice, which notifies the company that the agency is contemplating suing OpenSea. Although the announcement was light on details, what do you think this Wells notice might be about?
My guess is that the SEC is continuing its campaign of treating anything crypto like a security. And that means that in OpenSea's case, I'm guessing they're going to allege that OpenSea is running an unregistered exchange. We've seen this litigation. There's been a change in the SEC's strategy over the last 5 or 6 years in this space. Initially, they were going after issuers of cryptocurrencies or underwriters of cryptocurrencies. And starting in 2023, they started going after exchanges, principally Kraken, Coinbase, and Binance. So if I had to guess, because the Wells notice hasn't been made public, it's a document which was provided to OpenSea by the SEC. My guess is that they're probably going to make a similar allegation against them.
And so that then means they'll go after the platform, but the actual issuers of whatever NFTs they're alleging are securities will not be given a chance to defend themselves in court?
It depends on which issuers they choose to go after individually. It may be that they later decide that they're going to go after certain issuers for issuing what they deem to be securities. They've done this in the past with individual issuers to kind of set a precedent, even though it's not a legally binding precedent. It's more a precedent and enforcement practice. And this was in August of last year. They went after 2 projects, one called Stoner Cats and one called Impact Theory. We can talk about those in a bit. But essentially, my guess is that the SEC's strategy, because they have limited resources, has been to focus on transaction intermediaries rather than issuers. Because if you wanted to go after every NFT token issuer in the United States, you simply wouldn't be able to do it. There are simply too many of them. So they're trying to be efficient with their use of resources by targeting OpenSea in this instance as an exchange.
All right, so now let's talk about that Stoner Cats case. This was a well-known one because it involved celebrities Ashton Kutcher and Mila Kunis. Can you summarize what that case was about and how the SEC concluded that the sales of Stoner Cats NFTs were securities offerings?
Sure. So Stoner Cats was a television show about a bunch of ganja smoking felines that lived together with an old lady in a house who was taking medical marijuana, and the cats, obtained access to the marijuana. And as a consequence of that, they became hooked on the marijuana. And so that was the sort of underlying basis for the show. The producers of the show, you're correct, Mila Kunis and Ashton Kutcher were involved. Vitalik Buterin was also involved. Excuse my friend here, who's just interrupted our podcast. So deciding he wants to get involved too when we're talking about
for audio
animals.
Listeners, it's a cute, is that a golden doodle or?
A toy poodle has just jumped into my lap,
Okay.
which is very uncharacteristic. So Stoner Cats also issued a procedurally generated series of NFTs. So it was, the typical thing where they have various attributes and characteristics, and people, you've got a cat with the googly eyes, you've got a cat that's brown, you've got a cat that's green, that sort of stuff. And what they did is they sold those. And they said that as part of the program, what they were going to do was issue these NFTs, and they were going to use the proceeds from those NFTs to develop the television show and other types of offerings. The SEC, or rather US federal law, has a test called the Howey test, which is used to assess whether a particular thing being sold is an investment contract and therefore regulated as a security. That test is that there's an investment of money in a common enterprise with an expectation of profit arising from the efforts of others. And so the SEC said, well, you're selling these non-fungible tokens, right? They're not necessarily exchangeable one for one with each other like a coin or a cryptocurrency. But in our view, the sale of those things is sold with an expectation of profit from a common enterprise being the show and the efforts of others, which those profits will arise from the efforts of others, which chiefly are the producers of the show, creating demand for those NFTs by producing the show. So they brought an enforcement action on that basis. I'm not sure it was the strongest enforcement action in the world, but as it happens, the Stoner Cats project folded like a cheap suit, and the SEC got its enforcement precedent.
And when you say you don't feel like it was necessarily the strongest case, what are the aspects that you felt were weaker?
Well, I think there's a bona fide case to argue that selling merch, right, for a television show or a podcast or something else is something that people do so that they can collect those things because they like it, because there's a predominantly consumptive use for the asset. If we compare that to another project that the SEC also enforced against called Impact Theory, or about the same time as Stoner Cats, I think like 2 weeks before they announced the settlement. Impact Theory was a financial offering. You were buying tokens. Those tokens were linked to particular rewards. There was no particular reason to hold them. There was no artistic value to the thing. And there, I think the SEC was on stronger ground to say, listen, the thing that you're selling here, that is in fact a security. And so we're going to bring an enforcement action against you on this basis. With Stoner Cats, it's much weaker, right? It's a much weaker case that they can bring. And I think OpenSea is going to have some actually pretty strong defenses in relation to its role as a host of user-generated content on the internet from this civil litigation that's been brought by the SEC, because it's pretty clear that the purpose that OpenSea served, at least in my view, was to sell collectibles and artwork and other things, and not to act as a financial exchange.
Yeah, I did happen to see some commentary on Twitter where somebody said, oh, there were actual securities even being marketed as securities that were being sold on OpenSea. And one was some example of they screenshot an example of some kind of investment opportunity being sold as NFTs on OpenSea. So, in that case, like when it's something so obvious like that, is that something like you're basically saying that OpenSea's purpose was not to sell that? They weren't claiming that they were selling that. So you're saying that their purpose was to sell something of a different nature. Is that it?
OpenSea had policies and procedures which prohibited the sale of securities on the platform. I was involved with one project that was debating selling an ownership interest in something via OpenSea. And OpenSea said no, because they said, listen, this is an ownership interest. This is very clearly a security. It's not something that we want to be involved with because we don't want to be a registered securities exchange. This means that OpenSea is actually in a funny, it's unlike, say, a Binance or a Kraken or a Coinbase. OpenSea is actually a platform for user-generated content, right? That's the stuff that's being sold. And what makes that more interesting than a traditional exchange case, and I'm not surprised the SEC is blind to this because they're not internet lawyers, they're financial lawyers, is that the US actually confers immunity from civil liability on companies that host user-generated content and aren't otherwise attempting to procure a violation of federal criminal law. And that's called Section 230 of the Communications Decency Act. That says that OpenSea is not to be treated as the publisher or speaker of any content which is posted by its users. And to the extent that the predominant quantity of content that's on OpenSea was in fact artwork, and what the SEC is doing is it's cherry picking a couple of projects that snuck through their content moderation procedures and their policies and procedures around limiting the sale of securities on their platform in order to bring this enforcement action. I think OpenSea is going to have a really good argument that they're civilly immune under federal law, which is not an argument that you would have in the case of Coinbase or Binance or Kraken, because there you don't actually have people posting user-generated content onto a facially neutral internet platform, which is designed for something else. you could post, just as you could sell securities on Craigslist, right? You could go into the used boat section of Craigslist and say, hey, I've got 1,000 shares of my new company that I'm selling. That doesn't turn Craigslist into a securities exchange, right? That means Craigslist is just being misused by somebody to sell a security on a platform which is not intended for securities exchange. So I think this is really a very different case than what you would normally have seen with any of the other big name exchanges and those enforcement actions. And this one, I think, is actually a loser for the SEC as a result.
Okay, yeah. And actually, for the Stoner Cats case, SEC Commissioners Hester Pearson, Mark Uyeda made a dissent. Did you read that, or could you recall kind of some of the points they made there?
Yeah, I did at the time, but that was a year ago. So I should have reread it before the podcast. So forgive me for
I'll
not
just
doing so.
mention briefly some of the points. Was one, they were saying that the SEC, I don't know if the phrase is at fault is really the right phrase, but just that the responsibility is on the SEC to give artists some clarity around how to legally issue NFTs. That was one point they made. Another one was they actually said that they felt that the Stoner Cats NFT offering was more like fan crowdfunding, is the phrase they used, rather than a security sale. So, it does seem that even within the SEC itself, there was disagreement about how to approach that particular case. So in a moment, we're going to dive a little bit more into impact theory and some of the other cases involving NFTs and the SEC. But first, here's a quick word from the sponsors who make this show possible. Gemini is a crypto exchange with tools for all traders. Cameron and Tyler Winklevoss founded Gemini in 2014 and have been pioneers for the crypto industry for over a decade. Gemini operates with a security-first mentality. From being a licensed full reserve exchange and custodian to offering leading security features like passkeys, Gemini continues to set the bar for compliance and innovation. Head over to gemini.com/unchained and start trading to earn $15 in Bitcoin. FBTC is an omni-chain BTC asset contributed by Mantle Network and Alpha Global. Launched in early July, FBTC's TVL has already passed $125 million, making the fastest growing BTC asset this summer. FBTC's points-inspired campaign, Sparkle, has officially started, with lucrative and sustainable yields, plus points and token airdrop from Babylon, Mantle's new token cook, and more. FBTC is the BTC solution you've been waiting for. Visit fbtc.com/ongoing-campaign today. Join 20,000 attendees for the world's largest crypto event, Token 2049 Singapore, September 18th to 19th. Anatoly from Solana, Kyle Samani, Imad Mostak, and 300 others will hit the stage for an immersive festival experience ahead of the Formula One Grand Prix weekend. Singapore will transform into a buzzing crypto hub from September 16th to 22nd, with over 500 side events taking over the city. Visit token2049.com for 15% off tickets with the code UNCHAINED, link in the description. Back to my conversation with Preston. So as you mentioned earlier, there was that other case about impact theory, and you said that was a stronger case. And so what is it about that case that you feel, is more clear cut?
With impact theory, the NFT form was used, but the representations around what the NFTs were very clearly security-like in nature. They were promising people that if they bought a particular token, they would receive a particular reward in accordance with a particular schedule. And so that when you run the analysis for the Howey test, right, it's a facts and circumstances-based analysis. And it doesn't matter whether you write us an investment contract on the back of a napkin or whether you put it on a piece of paper, or whether you've put it in digital form and put it up on the blockchain. The question is, what is the underlying economic reality of the thing that's been sold and the manner of its sale? And so with impact theory, unlike Stoner Cats, there really was no other use for this thing. And the predominant use of it was as an investment product. You wouldn't be buying the impact theory tokens really for any other reason except for the fact that you wanted to make money. With most of the art projects that you see, the procedurally generated art projects that you tend to see in NFT things, the pudgy penguins, the miladies, the this, the that, there are very few, if any, promises which have been made around what a project is going to do to cause those things to increase in value. A lot of the times you'll see just NFT projects that are AI generated art, for example. I have one that's I have a giant collection of marmot NFTs that I've collected that are totally stupid and they're totally wonderful. And there was no promise made whatsoever. in relation to those things. So OpenSea, is in a position where it has to be able to support NFTs on Ethereum. I think and other platforms. I think the overwhelming majority of those things, of those NFTs, are being sold for consumptive use as art and not being bundled together with other things. And I know that OpenSea had a moderation policy where they would boot off projects that were too security like. So impact theory was one of I don't know if they were booted off of OpenSea, but that's an example of a project which is very clearly within the SEC's jurisdiction. I'm not sure it puts OpenSea within the SEC's jurisdiction because of Section 230, but I am pretty sure that most NFT projects don't work the way that impact theory did.
Yeah, and then there's also the case of Nate Chastain, the former OpenSea product manager who was buying NFTs before he featured them on the OpenSea main page, which he then would sell later at a profit. How does that particular case affect any potential lawsuit by the SEC against OpenSea?
I don't think it really affects it at all. If memory serves correctly, that case involved wire fraud. So basically, if he was engaging in deceptive practices, he was taking advantage of confidential information in order to purchase and sell things in a manner where the market wasn't privy to the same information he was, and he had obtained that information through false pretenses. Chiefly, he was an employee at the company. He was using that information to trade, and that wasn't within the scope of his employment or authorized. So when you're dealing with tokens in the marketplace, and this is something that people do all the time, it's generally speaking best practice if you're holding insider information, even if the things aren't securities, that you're not trading on that material non-public information. Because if you do, someone can say, hold on a second, when you authorized that transaction, when you signed off on it, there was a material omission or misrepresentation as to what you were doing, and I wouldn't have sold it to you if I had known otherwise. So there's a degree of honesty which is required. And if you have confidential information and you're using it in an unauthorized sort of way, you can get in trouble for that. That's a criminal problem rather than an SEC civil problem. So I don't think it has that much of an impact on this case. If you were doing the same with securities, that's certainly an SEC problem from a civil enforcement perspective. And maybe they're going to allege that it's a civil enforcement problem from their perspective. But you can get in trouble for that if you're dealing with any other kind of asset as well.
All right. And then there was also this class action lawsuit against Dapper Labs that alleged that NBA Top Shot NFTs were securities offerings. That got settled for $4 million. I didn't know if that could have any bearing here, but I just wanted to mention it to see what you thought.
There's a lot of plaintiffs' class action litigation in the NFT space where you have someone who bought a thing. They'll go to some lawyers. They'll say, I lost some money. That'll be your class representative. They'll bring the class action. They'll get a fee out of a settlement. $4 million, all things considered, is not a lot of money for a class action settlement for a project of Top Shot's size. In my opinion, Top Shots isn't a security. It's something which is a collectible, a digital collectible. Yes, there's a colorable argument that you can make that these things are securities. I think we could benefit from additional clarity, which provides some, firm guidelines that issuers of digital collectibles can comply with, because people have been collecting, basketball cards for 100 years, right? And sports cards for 100 years. So it's clearly a category of asset that people can buy, that they're going to want to buy in the future. And we should carve out a space for that kind of commerce to thrive on the internet. So I don't think it's of much immediate relevance. It's certainly of no real legal consequence. If it's settled out of court, didn't get resolved on appeal, you're not looking at any binding legal precedent being created there. It's $4 million, to be blunt. It sounds like a nuisance payment being made by Top Shots in order to make the case go away and have the issue be raised judicata. So that I don't see that as being especially relevant to the Wells notice that's been issued to OpenSea.
The SEC has recently been dropping several different crypto investigations, such as Ethereum 2.0, Stacks, Paxos, and I wondered what you thought was the likelihood that they would actually sue OpenSea.
I think if a Wells notice has been issued, that suggests that they are going to sue OpenSea. That doesn't happen until the SEC is about 3 to 6 months away from filing a lawsuit. They've concluded their investigation. They've reached some preliminary conclusions, and they're ready to rock. So in this case, I think we should expect to see a lawsuit against OpenSea. And your listeners might be wondering, why is this different? I think they must think they can win, to be blunt. Whereas in some of the other cases, they might think that the enforcement action is tenuous, or it's dependent on very subtle interpretations of securities law or other types of violations which aren't in the agency's interest to pursue. But we can't, without actually seeing under the hood, we don't know what the real answer to that is.
Okay. Well, so then at the same time, we also have a recent lawsuit by musician Jonathan Mann, aka Song a Day Man, and conceptual artist Mann Frye, who both sued the SEC together to find out whether the art that they create as NFTs will be deemed securities. So, assuming that the SEC does actually sue OpenSea, how will the case that Song a Day Man and Mann Frye have brought against the SEC intersect with that potential lawsuit in the other direction?
Yeah, Mann Frye, it bears mentioning, is also a professor of law at UK College of Law in Chicago. So he knows his stuff. He's a very competent internet lawyer, and I like him a lot. And they hired Jason Gottlieb, who's arguably the best litigator in the space. So that's quite if for your listeners who aren't familiar with that case, it's worth looking into it. It's very serious business. There's no direct impact from one piece of litigation on the other. There are different facts. There are different parties. What I'd say is, though, the fact that the SEC is suing OpenSea at the same time that you have pretty smart people also asking the SEC for a declaratory judgment, which gives them clarity and clearance to engage in bona fide artistic activity, suggests that the current regulatory approach being adopted by the agency is maybe less than appropriate for the space, and that maybe they're overreaching in the OpenSea case. I think if they're really trying to suggest that OpenSea can't operate a digital marketplace or an online marketplace for digital art because a handful of projects that might go on that marketplace are securities. Firstly, I think that that's a loser because I think OpenSea is immune under Section 230 of the Communications Decency Act from this lawsuit, and I would be very surprised if they didn't try to raise that immunity in their answer to the SEC when the SEC finally sues. And also, at what point are we in the United States going to get a regulatory regime that acknowledges that people use the internet for different purposes than they used it for in 1990 or 1980 or 1970? It's not a bunch of nerds, at DARPA, trying to do packet switching anymore. It's not just office email. We have these new products which people are buying and selling, which are very closely related or very akin to things that they would collect in the real world. Because why? People spend most of their time online. You can't share your baseball card that's sitting in a drawer in your house with one of your buddies when you're out and about and show it to them on your phone or various other things. So these are new product categories for a new economy, which is being driven by new methods of exchanging information. And the SEC looks at it and says, well, it's all security, right? When it's clearly and obviously not in any traditional definition of that term.
So while all this is going on, Republican nominee Donald Trump is releasing his fourth NFT collection. And I noticed on the website, they're calling them digital trading cards. However, they are not transferable until January 31st, 2025. And they're also being marketed as being, quote, for individual enjoyment only, not for investment purposes. And it seems to me, just as a non-lawyer, like these statements are designed specifically to avoid the SEC's wrath. But I was just curious for your thoughts on, how they're being marketed and just this contrast.
I confess I haven't looked that closely into the Trump digital trading card ecosystem. You see, that kind of language is pretty typical. It's scare language because ultimately what matters is the underlying economic reality of the transaction. Absent any other promises about making money from purchasing these cards, or Donald Trump saying, I'm going to go build an ecosystem and you can expect these cards are going to go up in value as a result of my managerial efforts of that enterprise, I don't really think there's a strong argument that, based on what I've seen before from the Trump ecosystem in terms of trading cards, it's just pictures of Donald Trump, a picture of his face being photoshopped onto the body of a fireman or the body of a guy in, Rambo or something like that. It's pretty corny stuff. And generally speaking, you're not looking at someone that's saying, oh, and you can join the Trump club and you'll get discounts on this, and trying to bundle together all kinds of other benefits if you purchase the card, which is, I think, where a lot of these NFT projects get into trouble. And Trump doesn't need to do that because he's Donald Trump and because people will buy his merchandise because they're big fans of him from his political activities or for various other reasons. So I think that's probably comparatively low risk. I confess I haven't looked at it. I'm certainly not advising on that project. So it's hard to know, as just an external lawyer looking in, what the underlying project's intentions are. There's a lot that's unseen, but there's not everything I've seen about the Trump trading cards project to date hasn't really made me look at it and say there's a regulatory problem there.
And, lastly, obviously, the SEC is kind of a very political figure at the moment, because a lot of people who are Democratic leaning would say that the SEC is almost purposely causing crypto voters to flock to Donald Trump as their preferred presidential candidate. So I just wondered if you had any thoughts on what this action by the SEC so close to the election says to you, either about the election itself or how a Trump or Harris presidency might handle crypto.
I think most people in crypto who have opinions on the US election one way or the other are pretty set at this point. I don't think there's a big undecided middle looking to go one way or another. What we tend to find is that Trump people are in crypto are single issue voters. A lot of them aren't traditional Republicans or MAGA Republicans in particular who are minded to support other parts of the platform. They just say, listen, it's going to be good for the industry because Donald Trump's embraced us. Similarly, I think a lot of the Harris supporters, to be blunt, aren't voting on crypto issues at all, but they've decided that their personal efforts should put Kamala Harris in office because they think that she's the right candidate for president, and their personal politics, take precedence over their business interests. So I don't think it really moves the needle. I think it's very indicative of what we would expect under a second Harris administration or a second Biden administration, whatever we want to call it, a continuation of what we've seen so far. If Kamala Harris is elected, she's going to put very crypto hostile people in very senior positions in government. And so the power of the federal government is going to be leveraged against our industry. And we can expect to see more of this and not less. If President Trump gets into office, depending on who he appoints as the head of the SEC and also what market structure regulations they can get through Congress. So far, they've proposed that they're going to have market structure regulations within the first 100 days. So that was a campaign promise he made. Pretty ambitious, but directionally, it's very different from what we've heard from the Harris campaign, which has essentially said nothing of any utility to the crypto industry.
All right. Well, thank you so much for explaining it all on Unchained.
Great to see you. Thanks so much.
Don't forget, next up is the weekly news recap, today presented by Wondercraft AI. Stick around for This Week in Crypto after this short break. Polkadot is the original and largest Layer 0 blockchain with over 2,000 plus developers. The anticipated Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, upgrading the infrastructure with 8 times higher transaction throughput and twice as fast block times, tailored core time for the needs of every protocol, trustless bridges to multiple chains, and revised tokenomics with a token burn to reduce inflation. Perfect for GameFi and DeFi to build, grow, and scale. Get your Web3 ideas to market fast. Think big, build bigger with Polkadot. Join the community at polkadot.network/ecosystem/community. Did you know you can buy and sell crypto with tax benefits in an individual retirement account or IRA? iTrust Capital makes this possible. But what does this mean? When you buy crypto outside an IRA, like on an exchange, you face taxes on gains. But in a Roth IRA, gains would be tax-free. iTrust Capital also has the lowest fees in the industry and 24/7 accessibility. Start now and maximize your retirement savings with iTrust Capital.
Welcome to this week's Crypto Roundup. In today's recap, we cover Telegram CEO Pavel Durov's arrest and its impact on Toncoin, Binance's rebuttal against asset freezing claims, and MakerDAO's rebrand to Sky. We'll also update you on the latest from the Celsius and FTX bankruptcies, the SEC lawsuit moving to trial against Kraken, and Coinbase's Base network reaching a milestone. Lastly, a crypto startup's unique method for detecting North Korean hackers goes viral. Thanks for tuning in to the weekly news recap. Let's begin. Telegram CEO arrest sparks market reaction. Telegram CEO Pavel Durov was arrested at Paris's Le Bourget airport on Sunday, following a cybercrime investigation by French authorities. According to the Tribunal Judiciaire de Paris, the charges against Durov include providing unauthorized cryptology services, facilitating illicit transactions, and other serious allegations, such as distributing illegal content and money laundering. Durov, now under judicial supervision and prohibited from leaving France, has undergone multiple interrogations, and an arrest warrant has been issued for his brother, Nikolai Durov. Durov's arrest had an immediate impact on Toncoin, with the token dropping nearly 20% after the news broke. In addition to the market downturn, the Ton blockchain suffered 2 outages in recent days. The network issues, which occurred on Tuesday and Wednesday, were attributed to heavy loads from the minting of DOGS tokens. The network was back up and running after a few hours on each occasion. Binance CEO refutes claims of freezing all Palestinian funds. Binance CEO Richard Tang has denied allegations that the exchange has frozen all assets belonging to Palestinians, a claim made by No One's CEO Ray Youssef on X. Tang described the accusation as FUD, meaning fear, uncertainty, and doubt. He clarified that only a limited number of accounts linked to illicit activities were blocked, and emphasized that Binance, like other financial institutions, adheres to global anti-money laundering regulations. The controversy arose after Youssef shared a letter from Israel's National Bureau for Counter-Terror Financing about an asset seizure order. However, the letter did not specify who the recipient was. MakerDAO rebrands to Sky amid controversy over stablecoin control. MakerDAO, one of the most important and oldest decentralized finance protocols, has rebranded as Sky and announced the coming launch of its new USDS stablecoin and Sky governance token on September 18th. The rebrand is part of MakerDAO's broader endgame strategy aimed at simplifying the user experience and making the platform more accessible. Sky represents the complete transformation of Maker, said Rune Christensen, MakerDAO's founder, highlighting the intent of the rebrand to address previous user experience issues. However, the changes have sparked concerns within the DeFi community. The USDS stablecoin will feature a freeze function allowing assets to be remotely locked, a capability that contradicts DeFi's decentralized principles. While Christensen clarified that the freeze function is optional and will not be active at launch, many DeFi enthusiasts are uncomfortable with its inclusion. AJ Scolaro, a senior analyst at Masari, argued that the feature is necessary for regulatory compliance and the growth of real-world asset-backed stablecoins. In addition, a journalist from Foresight News was able to acquire MakerDAO's former handle on social media platform X during its rebrand, and plans to keep it for its collectible value and to boost traffic to their website. Discussions with Sky to return the handle are ongoing. Celsius and FTX bankruptcy updates. Celsius has distributed over $2.5 billion in liquid cryptocurrency and cash to approximately 251,000 creditors as part of its bankruptcy plan, covering around 93% of the total claims against the firm's value. About 121,000 eligible creditors still need to claim their distributions, with most having claims of less than $1,500. The distribution follows the United States Southern District of New York Bankruptcy Court's approval of Celsius's reorganization plan. In the FTX bankruptcy case, the U.S. trustee has raised objections to the exchange's amended reorganization plan, criticizing its broad legal protections and unequal treatment of smaller creditors. A group of creditors also filed complaints seeking in-kind distributions to minimize tax burdens. The FTX bankruptcy plan's confirmation hearing is scheduled for October 7th. SEC lawsuit against Kraken can move to trial, judge rules. A California federal judge has ruled that the SEC's lawsuit against Kraken can proceed to trial. The SEC filed the lawsuit last November, alleging Kraken operated without registering as a broker, exchange, or clearinghouse, violating federal securities laws. U.S. District Judge William Orrick found that the SEC plausibly argued that some cryptocurrency transactions on Kraken could be considered investment contracts under securities laws. While the judge agreed that cryptocurrencies themselves are not securities, he noted that contracts surrounding their sale could be. Kraken's motion to dismiss the case was denied, and both parties must propose a trial schedule by October 8th. In related news, Abra settled with the SEC over charges related to offering unregistered crypto asset securities through its Abra Earn product, agreeing to pay civil penalties without admitting to or denying the allegations. Base surpasses 1 million daily active users. Base, Coinbase's Ethereum Layer 2 solution, has exceeded 1 million daily active addresses for the first time, recording 1.05 million of them on Saturday and 1.03 million on Sunday. This represents 71% growth in active addresses over the past 30 days, with the surge positioning Base ahead of other major Layer 2 networks. Base now has more daily active addresses than Arbitrum, Linea, and Mantle combined. The recent introduction of Base names, which are unique on-chain identities built on the Ethereum name service, has driven activity, with over 200,000 base names minted so far. Time for fun bits. Crypto startup's hilarious North Korea spy test goes viral. A crypto startup has found a creative way to spot potential North Korean spies, asking job candidates to curse North Korea. According to Harrison Leggio, aka Pop Punk on X, the test is simple. Ask the applicant to say, "I hate Kim Jong-un, F North Korea." When one candidate was asked, they immediately deleted the chat, raising eyebrows. The internet loved it, with users joking about adopting this North Korea litmus test in their own hiring processes. The idea comes amid reports that North Korean hackers, posing as remote workers, are trying to infiltrate tech and crypto firms to fund their regime. And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.substack.com, that is unchainedcrypto.substack.com, and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aronovich, Megan Gavis, Pam Majumdar, and Margaret Correa. The weekly recap was written by Juan Aronovich and edited by Nelson Wang. Thanks for listening.
Unchained is now a part of the CoinDesk Podcast Network. For the latest in digital assets, check out Markets Daily, 5 days a week, with host Noel Atchison. Follow the CoinDesk Podcast Network for some of the best shows in crypto.